Hi everyone. So today we are going to talk about SIFs, which is specialized investment funds. Now these are new kind of mutual funds which gives mutual fund managers some more ability to do certain things that they were not allowed to do earlier. So earlier in mutual funds, the managers are not allowed to take short positions. They can only hedge whatever they are holding. So if they are holding a specific stock and they want to hedge that specific exposure, then they can take some short exposure against that long holding, but they can't go short. But in SIFs now, these mutual fund managers will be allowed to go short up to the extent of 25%. So to understand this, first let's understand the long short strategies, what they are. So in long short strategies, what happens is you are allowed to go short. So let's say you have 100 rupees. Now in long only mutual funds, with that 100 rupees, you find out whatever stocks you want to go long on and you buy those specific stocks. Whereas in these long short strategies, what could happen, let's say possibly, is out of those 100 rupees, 75 rupees you buy shares, which is go long, and rest 25 you actually go short. So if you are really bearish on certain stocks and you feel they are not going to do very well, in fact they are going to fall down, managers would actually go short in those specific stocks with maximum 25% of the total capital. So your overall gross exposure, if you see, will be 100, which is 75 longs and 25 short, but your net exposure will be long minus short, which is 75 in long minus 25. So your net exposure in the markets is actually going to be just 50%. Now let's understand the implications of this 50% in the next few slides. Now to understand long short, let's take three separate strategies. So first strategy is long only, the regular mutual funds that you see. Second strategy is SIFs, in which 75% is long exposure and 25% is short. And third, for this example, let's also take a hybrid strategy in which you have, say, 75% invested in equities and rest 25% invested in debt. Now let's see how these three strategies perform in three different market conditions. One is bullish market, in which, say, market goes up by 15%. One is flat market, in which market gives 0% returns over the year. And third is the bearish market, in which markets are down 10% in the last 1 year. And let's see how these three strategies perform in each of these three market conditions. In bullish markets, the strategy one, which is long only, since the market has gone up 15%, and I'm assuming here that the manager is unable to add anything on top of it, no alpha. So market goes up by 15%. The long only strategy, which is strategy one, goes up by 15%. But the second strategy, which is the SIF, what happens to that? So your 75% exposure goes up by 15%, but the rest 25% of the exposure, because you are short, you lose 15% on that. So your net returns in this is going to be just about 7.5%. And finally, in the hybrid, which is 75% equity and 25% debt, you get about 13% returns in a bullish scenario. Now let's consider the second scenario, which is a bearish scenario, in which markets fall 10%. So in that, long only obviously would fall just about 10%. Now your long short, because you just have 50% net exposure, is going to fall less, which is about 5%. And your hybrid would fall about 5.5%. And now let's consider third scenario, which is flat markets, in which long only gives you flat returns, that is 0%. Long short also gives you flat returns because the longs and short both sides are flat, and the hybrid actually gives you about 2% because of the 25% exposure in bonds. So net in bullish markets, the best strategy is long only, but obviously that has the highest risk also. In bearish markets, these SIFs are going to perform as good as a hybrid fund, which is 75-25. And in flattish market, the best strategy would be the hybrid one, which gives you at least 2% returns. Now let's have a look at the comparison between these SIFs, the regular mutual funds that we have, the PMS and the AIF. So in terms of minimum investment size, your mutual fund actually starts with 500,000 or even maximum 5,000 rupees, whereas these SIFs are going to have minimum investment criteria of 10 lakh. And for PMS, this number, as we know, is 50 lakhs. And for AIFs, which is the hedge funds, this number is 1 crore. The strategy in mutual funds, mostly it's long only or hybrid strategies. In SIFs, you can actually go long and short both, but the maximum short exposure that you can take is just about 25%. In PMS, it's long only mostly, whereas AIF gives you much more flexibility of longs and shorts. You can actually do 50-50 also, in the sense that the managers takes 50% long positions and 50%. So you're actually fully market neutral, fully hedged. The leverage allowed in mutual funds, SIFs and PMS is 1, whereas the leverage allowed in AIFs is 2. So by giving 100 rupees, the manager can actually take exposure worth 200 rupees. In terms of regulatory oversight, the mutual fund and SIFs, they are considered under mutual funds category only. So there's high regulatory oversight, whereas in PMS and AIF there are certain less regulations, so maybe about medium regulatory oversight there. And in terms of taxation, the mutual fund and SIFs are the best because SIFs are also going to be taxed as good as mutual funds, and in PMS and in AIF also it's as per your strategy, whether it is long only, it could be LTCG, it could be STCG, it could be other income, which could be through futures and options as well. So finally, talking about these SIFs and long short strategy, I feel they are actually meant for conservative investors, and one should really not compare these two long only funds, because long only is totally different category. If you're actually bullish on India, which many people are over long run, then the best bet is through these regular mutual funds that you have. These SIFs are for conservative investors because here the market exposure would be just about 50%. You're 25% short as well. So in terms of returns, I don't think it's going to give as good a returns over long run, because over long run equities are expected to give 12-15%. So this would be definitely lower because you have short component, although there could be few managers in the long run who are able to do a very good job of shorting certain stocks, certain weaker stocks, and they might give you as good returns as long only. But we'll see how that goes, because as of now the SIFs are just being launched and they have close to zero track record. So the point being that don't compare it to long only funds. If you're bullish on India, then that's the best bet, but this could be considered as an alternate to hybrid funds. I think more or less in that category it's going to be, but overall, should you invest? Would I invest right now? No, I'm not going to invest in SIFs right now, because I just want to see how they perform. At least they have a track record of at least 1 year, and only then I'm going to allocate some part of my capital. If I find there are certain good SIFs, only then I'm going to invest. Otherwise, I'm happy waiting for longer, because I don't think they offer something really meaningful as of now, so as to I go in without a track record. So my advice would be to wait at least for a year and then see which all SIFs are there. But overall, I see at least hundreds of SIFs being launched over the next couple of years, because if you talk about these SIFs, there are overall 7 types of SIFs. In the 3 broad categories are equity oriented, which is having 3 subtypes. Then the debt also have 2 subtypes, and hybrid could also have 2 subtypes. So overall 7 type of SIFs each AMC could launch, and there are, I don't know, 40-50 AMCs. So you're definitely going to see hundreds of SIFs in the next couple of years. So let's wait and watch. Let's wait for a year or two and see if there are certain good SIFs, and if they are able to offer some differentiated returns, risk profile, then definitely it could be a good addition to your portfolio. But as of now, advice is to stay away from these SIFs.